This is an overview of financial results for the 11th period ended December 2017. First, operating revenue for the 11th period was 7,553 million yen. Net income was 3,607 million yen. That makes a DPU of 9,211 yen, exceeding the previous forecast of 9,111 yen by 100 yen. In addition to maintaining a high occupancy rate, increasing rent, reducing cost, and enhancing value, these results also include the gain on transfer from asset replacement. Next, for the 12th period ending June 2018, we forecast operating revenue of 7,219 million yen, net income of 3,285 million yen, and a DPU of 8,387 yen. We upwardly revised our forecast by 2.0% from the initial forecast of 8,225 yen. For the 13th period ending December 2018, we forecast operating revenue of 7,183 million yen and net income of 3,216 million yen. We currently forecast a DPU of 8,211 yen, which includes certain stress, such as assumed move-out for the area subject to renewal in this period, because we may receive cancellation notices. The graph on the left shows DPU transition since IPO. The original forecast is shown in gray. As you can see, the DPU has exceeded the respective forecast for each period. The graph on the right shows growth in NAV per unit. NAV was 324,820 yen in the 11th period, increased by approximately 31% since IPO during the past 3.5 years. First, external growth is shown on the left. Among the numerous initiatives taken in the 11th period, there are two initiatives worthy of special discussion. The first is asset replacement. We sold 2 properties that we had owned and acquired 3 new properties. However, by using an exchange scheme instead of simple sales and acquisition, we were able to increase distributions paid for existing unit holders and reduce the book value of assets acquired, which contributes to improvement in unit holders' value in the future. NIPPON REIT holds 66 properties at the end of the 11th period, and unrealized gains increased from 16.5 billion yen at the end of the 10th period to 17.9 billion yen at the end of the 11th period. Another noteworthy initiative is accumulation of our pipeline. During the 11th period, we arranged 2 bridge funds, Nicholas Capital 8 and Nicholas Capital 9, into a new bridge fund, Nicholas Capital 11, to extend the first negotiation period. Furthermore, NIPPON REIT has been granted right of first negotiation for 2 properties additionally by Sojus Corporation as sponsor support. As a result, NIPPON REIT currently holds the right of first negotiation for 13 properties, with an approximate value of 24.9 billion yen through these 2 bridge funds and sponsor warehouse at the end of the 11th period. Next, I will discuss internal growth. We maintained a high occupancy rate of 99.8%, which is the same level as at the end of the 10th period. In particular, the occupancy rate for offices was 99.96%, which is the highest level ever recorded. This is the result of our diversified portfolio and the tight supply and demand conditions for mid-sized offices. Moving on, the increase in monthly rent for contracts renewed in the 11th period was 3.5 million yen, thus maintaining strong results. The total increase in monthly rent from the 7th period is 16.44 million yen, equivalent to 197 million yen increase in rent on annual basis. If simply calculated, such rent increase contributes to an about 251 yen increase in a DPU. This is the result of our focus on the growth potential of properties as one of our acquisition policies. In the 12th period and later, we will continue the negotiation for rent increases by mainly targeting the contracts with negative rent gaps. Now, please see the situation of rent gap. While the average rent per tsubo of our portfolio was 14,596 yen as of the end of the 11th period, the average market rent was 15,449 yen. As a result, the rent gap stood at minus 5.52%, and the gap expanded further in comparison with the previous period, thanks to a steady increase in the market rent. This means that the possibility of rent increase has been widened in the future. This graph shows the total monthly rents of areas subject to renewal in respective period by the rent gap. The contracts with the negative rent gaps, which are indicated by dark blue and light blue in the graph, will be the target of our negotiations for rent increases. In addition, we will continue to work actively in the field of engineering management as another measure for enhancement of NOI. In the 11th period, we implemented measures to increase NOI by about 26 million yen. By doing so and combining the results from the 7th period to the current period with the plans for the 12th period, we will be able to contribute to an increase in NOI by about 213 million yen over the total 6 periods. If simply calculated, the amount contributes to an about 270 yen increase in a DPU. We will continue to engage in those measures. I would now like to explain our financial status. This graph shows trends in historical total interest-bearing debt, the long-term debt ratio, and the fixed interest rate ratio. Currently, the borrowing balance is 106,170 million yen. As the result of short-term borrowing in conjunction with asset exchange in the 11th period, both the long-term debt ratio and fixed interest rate ratio decreased slightly from 100% to 97.6%. LTV was 46.1% at the end of the 11th period. We will continue to control LTV in the range of 45% to 50%. The table in the bottom right corner shows an overview of refinancing executed in the 11th period. Borrowing terms have been extended to 6, 7, and 8 years while keeping level of borrowing cost. As a result, all-in cost increased slightly from 0.89% to 0.93%. While making every possible effort to suppress an increase in cost, we extended the average borrowing period to 4.84 years. Also, the average remaining borrowing period was extended to 2.78 years from 2.66 years at the end of the 10th period. In regards to refinancing in the 12th period and 13th period, we plan to follow essentially the same policy of shifting to long-term borrowing. We are also considering the issuance of new investment corporation bonds. We will continue management to achieve balance with overall revenue. The bottom graph is a debt maturity schedule. As you can see, we are shifting towards long-term borrowing while maintaining a diverse timing of maturity. Currently, our rating is single A flat, which denotes a stable forecast. An annual review meeting is upcoming next month.